Here's something that might sound backwards. The most dangerous thing your company can do with its money might be nothing. Not investing in a risky startup, not making a bad acquisition, literally doing nothing, leaving cash in the bank and assuming it's safe. Because in an environment where the money supply has expanded by over 40% in just 5 years, doing nothing leads to your company quietly losing its purchasing power every year. More and more companies are beginning to recognize this problem. So today, we're breaking down Treasury policy from the ground up. What it actually is, why it matters, and why Bitcoin, not as a speculation, but as a structured reserve tool, deserves a seat at the table. Hi, I'm Dr. Hunter Allbright, Chief Revenue Officer at SALT, former banking executive and professor at the University of Colorado Boulder. For nearly 30 years, I've worked at the intersection of credit, analytics, and emerging technology. From leading global portfolios in traditional finance to building Bitcoin-backed lending infrastructure today. This channel is about thinking clearly in a noisy world, understanding Bitcoin through structure, risk, incentives, and long-term value. Let's get into what Treasury policy actually is. If you're responsible for capital allocation inside a business, whether you're a founder, CFO, board member, or treasury manager, you're facing a challenge that didn't exist 20 years ago. Cash no longer behaves like a stable asset. In a world of persistent inflation, expanding monetary supply, and structurally low real yields, holding large cash reserves has become a real active decision, not a neutral one. So today we're going to talk about Treasury policy basics and why Bitcoin deserves consideration as part of a modern corporate treasury strategy. Now, this is not about speculation. It's about capital preservation, risk management, and long-term strategic positioning. Before we talk about Bitcoin, let's ground ourselves in the fundamentals. A treasury policy governs how a company manages your cash reserves, your liquidity, short-term investments, counterparty exposure, and capital preservation. At its core, treasury management has 3 primary goals: preserve capital, maintain liquidity, and optimize risk-adjusted returns. Historically, companies have achieved this by holding cash, treasury bills, money market funds, and short-duration bonds. All of these instruments were considered risk-free or close to it. But here's the issue. Risk-free used to mean low volatility. It did not account for purchasing power erosion. That distinction now matters. When inflation exceeds the yield on cash equivalents, you are locking in a guaranteed loss of purchasing power. This is not volatility risk, this is certainty risk. Over the last several years, businesses holding large cash reserves experienced real declines in value, even if their nominal balance remained unchanged. So, from a treasury standpoint, that introduces a new question. Is holding 100% of excess reserves in fiat cash actually the conservative approach? Or is it simply a familiar one? Treasury policy must evolve when the macro environment changes, and we are in a structurally different environment. Bitcoin is not just another investment asset, it is finite monetary network, a decentralized settlement system, a digitally native bearer asset, and a non-sovereign store of value. Unlike cash, it cannot be printed. Its supply is programmatically capped, and it operates outside traditional monetary policy systems. For a treasury team, this creates a unique profile. Bitcoin is the only global liquid asset with a mathematically fixed supply, and that matters. Because if your company generates profits in a currency that is being expanded indefinitely, holding a portion of reserves in an asset that cannot be expanded introduces asymmetry. No certainty, but asymmetry. Let's be clear, Bitcoin is volatile. Treasury policy is not about replacing cash with Bitcoin. It's about asking a strategic question. Should a percentage, a portion of your long-duration corporate reserves be allocated to a scarce digital asset with global liquidity and a fixed supply? When viewed through a lens of the long-term horizon, Bitcoin has historically demonstrated high volatility in the short term, strong appreciation over long-time horizons, low correlation to many traditional assets, and increasing institutional adoption. For a business with multi-year capital horizons, excess reserves beyond operating runway, and a mandate to preserve purchasing power, Bitcoin becomes a rational decision, not a fringe one. Now, most objections to Bitcoin in a Treasury context stem from volatility. And volatility absolutely matters, especially when capital must be readily available for payroll, vendors, and short-term obligations. That's why Treasury capital is typically segmented. Operating capital 0 to 12 months, strategic reserves 1 to 5+ years, and growth capital. For most businesses, Bitcoin evaluation begins with long-duration strategic reserves, not day-to-day liquidity. That's the prudent starting point. Operating liquidity prioritizes stability. Strategic reserves prioritize long-term purchasing power. As infrastructure and internal comfort evolve, the role Bitcoin plays with Treasury strategy can expand. But allocation should always follow policy and readiness, not enthusiasm. Treasury strategy is about alignment. Match asset duration to liability duration. Short-term liabilities require stability. Long-term reserves require resilience. Viewed through that lens, Bitcoin becomes a duration decision, not a speculative one. Another dimension rarely discussed: what does holding Bitcoin signal? In today's environment, it can signal forward-thinking capital management, conviction in long-term digital infrastructure, strategic diversification beyond fiat-only exposure. Of course, governance matters. Board approval, clear allocation limits, defined risk thresholds, transparent accounting treatment. But once governed properly, Bitcoin on a balance sheet is no longer unusual. It is increasingly part of the corporate treasury conversation. Any serious treasury discussion must address risks: price volatility, regulatory evolution, custody and security, accounting treatment, liquidity during downturns. These are all real considerations. But so are inflation risk, currency debasement risk, counterparty risk, and sovereign debt exposure. Treasury policy is about weighing risks, not avoiding them entirely. The question is not, is Bitcoin risky? The real question is, does holding zero Bitcoin introduce its own form of risk over a long enough time horizon? That's the different question. Now, why consider Bitcoin first? Let's address the title directly. Why consider Bitcoin as your first digital asset allocation? Because Bitcoin is the most secure network, the most decentralized, the most liquid, the most battle-tested, and the only digital asset with a truly fixed supply. There are thousands of digital assets, but from a treasury perspective, simplicity and durability matter more than experimentation. If a business chooses to explore digital asset exposure, starting with the most established, the most resilient network is a rational approach. Bitcoin is not a startup. It is infrastructure. For businesses considering this path, the conversation typically includes what percentage of reserves, what time horizon, what custody structure, what board oversight, and what disclosure framework. The answer is never all in. Treasury policy is about incremental, disciplined allocation. Even a 1 to 5% of long-duration reserves can materially alter long-term outcomes without jeopardizing liquidity. That's how the professionals think about this. Now, Treasury management is evolving. The assumption that cash is risk-free no longer holds in the way it once did. Bitcoin is not a replacement for sound Treasury policy. It's a new tool, a scarce, global, digitally native monetary asset operating outside of traditional monetary expansion systems. Every serious Treasury team should at least study it. Not because it's trendy, but because ignoring structural monetary shifts has often been more dangerous than adapting to them. This playlist is all about helping businesses understand the strategic foundations behind Bitcoin Treasury allocation. In other episodes, we'll explore Treasury policy design frameworks, allocation sizing models, risk management structures, custody considerations, and accounting implications. If you're responsible for capital allocation, this conversation is no longer optional. It's strategic.